What's going on, you guys? Welcome back to the channel. Economic Prepper here. Wanted to give you guys a quick update on what I'm seeing with the banks and what we could possibly see in the future going forward. I just want to share this information. I'm just one person here in the United States, but we are all using banking systems of some form or another. So I feel like if we just kind of share what we're seeing across the board, we can collectively help each other out in the comments. Other good channels like Kevin and Popular Preparedness, I forget how exactly they pronounce their channel name, but there's another number of other prepper channels that are keeping a close watch on what the banks are doing. But I personally bank with a number of different banks and credit unions, anywhere from Bank of America to Wells Fargo to JP Morgan Chase. I've got a number of different banks that I bank with for different reasons, anything from more advantageous savings account interest rates. In fact, I've been getting more and more letters and emails and marketing materials from the different banks and institutions that I work with, indicating that they're paying higher and higher interest rates, which is a plus for those who are having cash stockpiled and stashed away in some of these banks and credit unions. However, this creates a higher expense for the banks. It's higher monthly overhead because these are interest payments that these banks are having to make to entice account holders to leave their cash in the banks. Now, a number of people have a lot of concerns about the banks and whether or not you should leave cash in the banks. I'm not here to tell you what to do with your cash. I'm just letting you know what I am doing. And I'm also letting you guys know what I am seeing. Now, the banks are one of the bigger financiers of the used cars as well as new vehicles. And what we've seen over the last 18 to 24 months is we've seen a drastic increase in the prices of used cars. The supply chain has drastically dried up the availability of new cars. If you wanted to purchase a new car, most people were not paying cash for their new cars. Most people were not paying cash for their used cars. And if you wanted to purchase a new car, generally speaking, a lot of times the new car had to be ordered. You had to wait for it. And due to the supply chain problems, there was quite a bit of a delay. This further exacerbated the used car market and drove up used car prices because people needed new cars or people needed a replacement car. And if a new car wasn't available, well, heck, we'll just have to go ahead and purchase a used car. And a lot of people found themselves in that situation. The other thing is that used car dealers were struggling to make profits. Heck, even new car dealers were struggling to make profits because they lacked the inventory to sell. And so they had to raise the prices that they're selling their new cars for to make up for the fact that, hey, for the few new cars that they did have and for the increased demand, may as well make a bigger profit per unit sold. This also drove up inflation. And you know how the whole inflation goes. We've seen inflation in everything from the grocery stores to gas prices to housing prices, even rent prices. So there's almost no aspect of our economy that hasn't been hit with inflation of some form. But what we're seeing here is leaders of Americans' biggest banks, they're saying that they would follow any U.S. directive on pulling business from China if Taiwan is ever being attacked by Beijing. So this kind of goes back to, I feel like this has a lot to do with some of the inner workings that our political leaders, such as the Pelosi's, and I think it has something to do with, I'm not going to get too into it in this video. I want to stick to the banks, but I think it has something to do with the preemptive visit that was really being strongly advised against from China. And Pelosi really wanted to visit Taiwan for whatever her, personal or political reasons were. But I think it may have been a strategic positioning to kind of begin the divergence away from China. But anyway, so JP Morgan Chase, or I should say JP Morgan CEO Jamie Dimon, as well as Citibank CEO Jane Fraser and Bank of America CEO Brian Moynihan, they were all pressed on Wednesday, 2 days ago, by U.S. Congresswoman or U.S. Congressman Blaine Lutenmeyer from Missouri at a Capitol Hill hearing. And they went on to say that, quote, "we'll follow the government's guidance, which has been for decades to work with China. And if they change that position, we'll change it as well as they did with Russia." And so this is basically citing their corporate response to Russia's invasion of Ukraine. But here's the thing. Jamie Dimon said, and he issued several warnings this year that were quite notable. So Jamie Dimon, CEO of JP Morgan Chase, he issued a warning earlier this year that the United States and potentially the global economy could be facing what he predicted to be a economic storm. Paraphrasing. So Jamie Dimon of JP Morgan said, Jamie Dimon said JP Morgan would absolutely salute and follow whatever American government says, which is you all and what you want us to do. Now, what we're seeing here is not only are we seeing banks financing used cars, mortgages, credit cards, Visa, MasterCard, American Express. What we're seeing is we're seeing a shift in the used car market. We're seeing a pullback in the American consumer. The U.S. consumer is either running out of cash, they're living paycheck to paycheck, they're trying to avoid bankruptcy. But the reality is that the American consumer is starting to feel tapped out and or concerned. Not everyone's in the same financial situation, but what we're seeing is we're seeing a pullback in spending. CPI numbers came out recently. Core numbers came out. CPI number came out. It was 8.3% inflation rate. And unfortunately, this is not what the Fed wanted. So, of course, Fed Chair Jerome Powell just the other day indicated that he was going to be increasing the interest rates, the Federal Reserve interest rates, by 75 basis points. And so what this does is this makes lending more expensive for bankers. This makes lending more expensive for consumers. And we're seeing the most immediate impact in the housing market. Now, I'm not seeing housing market crashes. I'm not seeing housing prices declining to any great extent yet, but I am seeing a drastic decline in mortgage applications, which is affecting banks' profitability. We're seeing a drastic decline in the transactions, the home sales. But housing prices, for the most part, they've stayed where they're at. And so what this does is this has created a more expensive housing market for anyone looking to buy a house, whether you're a regular person like me and you, or you're a corporation like BlackRock looking to purchase bundles of houses for real estate investment. It's making it more expensive to purchase real estate. Now, BlackRock has the balance sheet to be able to purchase cash any type of real estate that they're interested in. However, the average American doesn't have the cash to just say, screw these higher mortgage rates right now. I'll just go ahead and pay cash. A report did come out, though, earlier this year that 25% of the home purchase transactions for 2021 were made with all cash purchases. 30% in 2022 of home purchases were made by all cash buyers. So it was interesting to see the uptick in all cash purchasers going into 2022. But what was also interesting to me was how many transactions were actually made with all cash offers, given the higher prices of home prices and real estate. But here's the thing that's concerning to me about banks. We've already heard from Wells Fargo indicating that they're shutting bank accounts down that they deem to be quote unquote high risk. Now, high risk, and I've been a victim to this in the past, where I had a ton of different credit cards. Me personally, I had credit card debt out the wazoo at one point. I had like $30,000 in credit card debt. It was ridiculous. And, I put myself on a strict financial budget. And I prepared, my family for what was coming. I was like, hey, this is like 15, maybe even close to 20 years ago. But I just said, hey, we got to clean up this mess. We can't sit out here with all these credit cards, interest rates constantly climbing on us. I had minimum payments that were like $400 or $500 for all the different it might have even been more than that for all the credit card debt that I had. Actually, it might have been closer to like $800, $900, because I had multiple different credit cards. Most of the credit cards, American Express, Bank of America, Visa, MasterCard, they were all of varying interest rates. And what I did was I managed to get some 0% interest credit cards, did a bunch of balance transfers, lowered my amount of money that I was wasting every single month on high interest, and eventually paid off all my credit card debt. So today I function, without carrying any kind of credit card balances, although I use a credit card for all purchases for a number of reasons. I mainly use my American Express for purchase protection. And it's smarter to use other people's money, especially, with when you take into consideration cashback, bonus points, and different things of that nature. So there's a lot of benefits to using a credit card, in my opinion, over cash. And there's a lot of benefits of using a credit card over a debit card. I never use my debit card, as a matter of fact, unless I'm going to the ATM to withdraw cash, which I do. Because it is smart to have cash. It is smart to have cash on hand. I'm just saying cash for me is more of a backup, not a primary source of payment. So more on that in future videos. So as mortgage transactions are declining, mortgage applications are declining, meaning future mortgage business will be declining. You can't have a mortgage without a mortgage application. So we can see that the future will be weaker in terms of profitability and volume of transactions for both the mortgage industry as a banker, and the housing market for the housing market. If you're a real estate agent, if you're a home buyer, more importantly, if you're trying to sell your home, you will know that the demand is going to be weaker because the reports have already come out that mortgage applications are down. So people are not looking to buy houses at the rate that they once were, mainly. And you can see this direct correlation to the increase in the Fed rates. And this is the driving force for why people are backing out of the housing market. Home builders are backing out of building homes, and they're building homes now by request. So they're getting would-be home buyers to basically commit to buying a house before it's being built. So this is what I'm seeing as a growing trend with home builders trying to hedge themselves from the market and making sure that they are not building houses that are not going to, get sold. They want to make sure that homes are being sold before they're being built. So this is actually slowing down the availability, and they're slowing down the housing market inventory increases, this is not helping bring housing prices down. So if home builders are slowing down on the building, the inventory and the supply is not increasing. So that would have been a factor that could have helped bring housing prices down, but I'm not seeing that personally. But from the bank standpoint, if the banks aren't closing as many loans, then that means that the banks aren't making as much money. This coupled with the fact that we're already seeing early signs that banks are shutting down what they're calling high-risk bank accounts. They're shutting them down. Wells Fargo has already admitted to doing that. I personally, after getting out of credit card debt, paying off all these credit cards years ago, I was taught to never use a credit card to buy things you can't afford. And I think that's wise. And I don't do that now. But a lot of people are forced to have to rely on credit cards just to make daily purchases, day-to-day expenses, going into Walmart, Kroger, whatever grocery store you shop at, Target, Costco, BJ's Wholesale Club, you name it, they're spending. And a lot of Americans, and a growing number, are using credit cards to make the transactions, because living paycheck to paycheck and, maybe even being on a fixed income, as your expenses are rising and your income is not, you're having to use leverage. And that leverage for most Americans comes in the form of a Visa, MasterCard, or an American Express card to fill the gap between the higher cost of food, gas, and groceries and other day-to-day expenses, and the wages that are not keeping up with the ever-increasing inflation. All right, so banks are not closing as many mortgage loans. So they're losing out on a tremendous amount of profitability, revenue, and this is hitting banks' balance sheets. banks are holding a tremendous amount of loans on used car and new car vehicles because of the whole pandemic, the supply chain problems. Used car and vehicle prices are unbelievably escalated. And this is one of the reasons why I didn't buy a new car over the last couple of years. And even though I kind of wanted one, I had a feeling like at some point there would be this pullback. And me personally, knowing that, for most vehicles, it's a depreciating asset. And while it's a necessity, depending upon the type of vehicle you buy, it is a want as well. But, I decided, hey, I'm going to hold off. I'm working on some other things. I'm trying to prepare for other things. Let me not purchase a new car now. Let's just see what happens going forward. Anyway, all of these banks have financed, maybe not all the banks. Some banks were more conservative than others, but a lot of banks financed a lot of these vehicles that were overpriced. And now as the market is correcting, we're starting to see a lot of these vehicles hit auctions and they're not selling. I watched a YouTube video not too long ago. I forget the channel name, but this guy was talking about how banks and dealers, they're bringing these cars to auction and the vehicles are rolling through and they're not selling. And so this is the banks and the dealerships not realizing that the market is correcting on the used cars. That's a whole nother story. But the fact of the matter is that as more and more Americans are not able to pay their bills, what is going to be the impact of the banks when they have to repossess these highly underwater vehicles? And what are the banks going to do with these vehicles once they repossess them? They're going to do what they always do. They're going to throw them in the auctions and they're going to keep rolling through and they're not going to sell. And these banks are losing money on these repossessions. This is money that they're not collecting their monthly payments on. They're not earning any interest on it. This is literally a huge liability for the banks. Couple that with the decrease in the number of mortgages that are actually being applied for and closing on. This is going to impact the banking industry as well. I can't imagine a single bank that would be sheltered from this impending crisis moving forward. And anyone that's tied to the mortgage industry, period. I mean, heck, anyone who's in construction, anyone who is in real estate sales, if you're a mortgage banker, if you're if you work for the banking system, period. I mean, I'm just saying, keep an eye out because the trend is changing. Fewer and fewer people are able to even qualify for loans because interest rates are so much higher. So when your debt to income ratio is predicated on payments, and when your interest rate is increasing and the cost of goods is also increasing, this is lowering your ability to get approved for enough money to buy whatever you're looking for. So more and more people are just turned off from the higher interest rate market thanks to the Fed. Inflation is still very high, and banks are not able to generate the kind of income that they used to. And based on what we're seeing here, if banks like, I don't know, Bank of America, for example, JP Morgan Chase, Citibank, Wells Fargo, if they have to pull out of China, especially with this whole massive Evergrande real estate problem going on over in China right now, this whole Evergrande China crisis with their real estate, with China's real estate market, this could be really, really bad. This is all I'm saying. This could be really, really bad for the banks. And I can understand why people are concerned about, putting cash in the bank. So I think it's always a good idea to be diversified, have multiple different types of credit cards, have multiple different types of bank accounts, whether it's, checking account, savings account at multiple different types of branches, having some cash in multiple different places. So this is what I'm seeing. You guys let me know what you're seeing. But I'm definitely going to keep you guys updated because this is absolutely an evolving situation, and it is absolutely going to get worse before it gets better. I don't see banks improving their profitability anytime soon. In fact, I'm expecting to see a whole lot of big time losses reported on their books and their balance sheets going forward. So keep an eye on the stock market. You guys keep preparing and prepping. Make sure your families are ready, and I'll give you the next update soon. Take care.